record on mute. Alright. Okay, so off we go. So you guys should all have copies of the slides that Anna sent out. So the way we'll run class is to show the slides on the screen. But you guys are welcome to follow, the screen or your own slides or whatever. But we will, I'm going to always project the slides in the same way that we're doing here. Okay? All right. So we're going to start at the very beginning of income tax provisions. This class is meant to be an introductory course. And so we're going to treat it as such. And we're going to start with the very basics. So even if you don't have provision experience, some of you guys are going to have tax return experience. And it's pretty common that people in the class who do have some kind of work experience come with a compliance type background and less of a provision background. What we're going to talk about in the class is tax accounting, right? So this is a tax class, but boy, not much of this is tax as compared to how much of this class is accounting, right? So the best thing you can do is start thinking in debit credit form as soon as possible, because this is very much going to be a debit and credit sort of class. Okay? So if we just start with the concept of a tax return, you guys are familiar with the fact that when you do a tax return, you start with book income and you make adjustments to get to taxable income, right? And those adjustments, like it's described in the second bullet here, are the Schedule M adjustments. And when you're doing a return, your goal is to start with book income, get to taxable income, and end up with the tax liability, right? So most people can wrap their head around the fact that if I made some money, I should probably pay some tax, and that tax is my tax liability, right? So if we just take that super simple concept and think, well, how's that going to be recorded for income tax accounting purposes, right? We did our return, but now we're going to try to do our accounting for it. How would we do that? Well, that's what this last journal entry here is on the slide. So we're going to think about, are we debiting something? Are we crediting something? And that's how I want you to think from a course perspective. Every time we do a calculation of a tax liability or a deduction or a add back, I want you to think in debit and credit terms. Okay? You'll see towards the end of tonight, we're going to go through some examples of how to do a provision, and it's all going to be debit and credit based. Okay? But if you start from the perspective of I understand a return and I understand how to get from book income to taxable income, that's a good start. Okay? That will help. So in my when we were talking about the earlier slide, I mentioned, well, if you have a company that makes profit, pays some tax, that seems pretty straightforward, and you could probably even think intuitively about how to account for the fact that you owe cash taxes, right? You probably have to credit a tax payable, and you would debit an expense, right? Like that would be a pretty logical thing to do. But if you see these questions on this slide and think, all right, well, what happens if this company has an NOL? Or what if they have credits? Maybe those credits get carried forward. Or what if there's something like depreciation where you take bonus depreciation and you get a huge deduction now, but you won't get a big deduction later? And if you start thinking, well, how do I record that? And I use my debit and credit theory, well, now it's not so obvious as I'm making money and I owe some tax example. Right? So in the class, we're going to learn all about, if you take an assumption like this, like an NOL, what do you do with it? How do you accrue for it for financial accounting purposes? Okay? So we're going to take what goes on a return and sometimes what's not on a return, and we're going to turn it into what we're going to do for accounting purposes. All right? That's our goal. Okay. So it's funny, this class is, it's been a very popular class every time I taught it. And not only do I teach here, but I also guest lecture at some of the undergrad schools. I teach at Cal Poly San Luis Obispo, and then also this year I'm teaching at Santa Clara. And the biggest difference I noticed between teaching with those groups and you is, and this is less so maybe of your group over time because it's become more full-time students, but early on as I was teaching this class, it was almost all experienced people. And they would almost all enroll in the class out of fear. And their fear was based on the fact that taxes are complicated and tax provisions are more so. And the problem with doing a tax provision wrong is when you screw up, it's really public. It's really out there. So when we have these guest speakers come to class, ask them about the times they screwed up. They remember it. I mean, I remember the times I screwed up. I mean, they're unforgettable. And if you screw up really bad, you know, you get in trouble with Sarbanes-Oxley provisions. And if you screw up really, really bad, you even have to say in your 10K, I screwed up really, really bad. And I don't even know what I'm doing, right? I mean, that's basically what a material weakness is. And so there's a lot of pressure on folks that are in charge of provisions of public companies to get it right. And the best thing that can happen to you if you're one of those people, if you're one of the guest speakers, the best thing that can happen is nothing goes wrong. Right? I mean, there's not like a victory party. It's kind of like a sigh at the end of the provision that everything went okay. So taxes are complicated, and every year since SOX has been law, the number one reason for material weaknesses is taxes, every single year. And so people would come to this class and they would be like, I need to know it, I can't not know it, I'm totally motivated. And then I would go to these undergrad schools and they're all these like 20-year-old kids and they're like, whatever, right? They're like, what are you talking about? And I would tell them, I'm like, you don't know to be afraid, you know. So anyways, it's a good question to ask some of the guest speakers though. Like tell me about a time when, you know, things went totally sideways. And I have good stories of all three of them, and so if you don't ask questions, I can probably prompt them into some good stories. But, yeah. Okay, so if you were to ask where am I going to find taxes on a financial statement, taxes are everywhere, okay? But not all taxes are the same, and we're here to deal with corporate income taxes, okay, which is a subset of all the taxes that are out there. We're dealing just with corporate income taxes. So if it's sales tax or VAT or payroll tax or property tax or expat taxes, we're not dealing with any of that. Okay? Those are all taxes and they all hit the financial statements. But this course is going to be on corporate income taxes. So oftentimes when I explain to my relatives or friends what I do for a living, I just tell them that one line on the income statement called income tax expense, I'm like, that's all I do. I just do that line. But it's amazing how much effort goes into the one line. One of my clients has a dozen people that just full-time do that one line. I mean, it's amazing how much energy goes into that. I mean, that's kind of a unique situation. But there's plenty of companies, including the ones that will have guest speak, that have several people full-time just do provision calculations. The one thing I'll say about this slide is keep in mind that one fundamental thing to wrap your head around is this class is all about accrual accounting, okay? And that's very different than doing a tax return. Like usually when you're doing a tax return, you're focused on what do I owe? What is my tax? Right? And that's a very cash basis theory. Right? If you're worried about, you know, we just finished all the 2012 returns with the 9/15 busy season. So everyone was focused on what do I owe with my 2012 return? What is my 2012 tax? Well, that's cash basis thinking from an accounting perspective. From an accrual perspective, we want to know, related to the income we had in 2012, how much cash am I ever going to pay in tax? Right? Did I pay it with my 12 return? Am I going to pay it with my 13 return? Am I going to pay it in 10 years? I want to know how much tax is being created by my 2012 earnings, and then I want to accrue for all that tax today. Okay? But it may not hit my tax return right away. And so our goal, if you think kind of with that pretty intuitive matching principle theory, is to take what shows up in profit before tax, which is the line right above what I spent all my time doing, and to match the tax with that profit. Okay? So if the profit is $100 and I'm sitting in the US and I pay tax at a 35% rate, and there's no other book tax differences, my tax should be 35. But it's never that easy, right? So I want that tax line to be the tax I'll pay on that 100 ever. Okay? Sometimes it could even be going backwards, right? If I lost money and I could carry an NOL back, right? I might actually have an income tax expense or benefit item this year that relates to something I'll carry back and refund for prior year's taxes. But I want to know the tax effects of this year's PBT, profit before tax. Okay? I want to match the tax with the profit. Okay? Usually for people that are in a compliance mindset, that is, although it sounds easy coming out of my mouth, it's not easy to just process because you're constantly thinking, that's not this year. But we don't care about just this year. We care about ever. Okay? The last bullet on here is a good thing for you to keep in mind as well, because for those of you who haven't had experience with provisions, when we cover the topic of deferred tax assets and deferred tax liabilities, usually your reaction is like, I don't know what you're talking about. This last bullet will be helpful to curing that. And what the last bullet basically says is, you should always look at a balance sheet and say, what would happen if I took my balance sheet and I converted it to cash at book value? Okay, so let's say I had a truck and I had it on my balance sheet for $8,000, okay, because books had depreciated it down so that its net book value was $8,000. We should, when we're doing our tax provision, we should think, well, what would happen if we sold that truck for $8,000 in cash? Okay, and if we did, it's possible that, like, let's say our tax basis in the truck was $7,000, okay, because we depreciated it faster for tax than books. So if we sold our truck for $8,000, but our tax basis was only $7,000, we would have a gain. Books isn't going to have a gain. Books just sold it for book value. But tax has a gain. We want to capture that. We want to know what that is today, because we want to accrue for that now. That exists, right? That basis difference between book and tax, that exists now. So be thinking, we're going to spend a lot of time talking about deferred tax assets and liabilities, but be thinking about, if I looked at a balance sheet and I converted it to cash, what would be the tax consequences? Okay? Because those tax consequences, if I had a gain, if I had a loss, we're going to book that. We're going to record things on our balance sheet that say, I'm going to pay tax in the future, or I'm going to save tax in the future, based on the theory that if I turn my balance sheet to cash, what would happen? Okay? As rudimentary as that sounds, I do that all the time, especially if I'm explaining something to a client and they're having a hard time. We'll be like, dude, what would happen if we just turned it to cash? Right? I mean, to this day, I use that in practice all the time, because it's just a simple way to cut through kind of the confusing terminology of what deferred taxes are. Okay, so I mentioned this in the video that I had you watch ahead of class, and that is one of the somewhat surprising things about provisions is most people think of an income tax provision as the income statement expense related to taxes, and that's what it is. But when you read the guidance for how to do a provision, it doesn't talk about the P&L. It doesn't talk about the income statement. It talks about the balance sheet. And if you get the balance sheet part of your tax accounts correct, the income statement piece will fall out. Okay? So when you read the guidance, and one of the reasons I assign you reading out of ASC 740 is I want you to actually read the rules and not just believe what I say. But when you read the rules, it's not easy. It doesn't read like a textbook at all. I mean, most times you'll read it and you'll be like, I don't know what to do with that. Right? That's a nice theory, but I don't actually know what I should do when I pick up a sample set of numbers and do a provision. But the second bullet here, where it says objectives, this is straight out of ASC 740. And what it basically says is, the main objectives for ASC 740 is to first accrue the tax you owe. So accrue a liability if you owe tax, accrue a receivable if you're owed money. So those are balance sheet accounts, right? Put a liability up and put a receivable up. The second thing is to record deferred taxes. So I kind of hinted at that a second ago. And in my truck example, we would have a deferred tax liability because if I sold that truck for book value, I would actually have a gain for tax purposes and I would have to pay tax. So what this second bullet says is you should put on your balance sheet a liability that says someday in the future, if I sold that truck for book value, I'd have to pay tax. Okay? So objective 1 is accrue the tax you owe now. Objective 2 is accrue the tax you'll owe in the future or save in the future based on book tax basis differences. And if you do those 3 things and you want a balanced journal entry to record your taxes, the provision will fall out. Okay? That is what we will learn tonight when we go through our problems. But that is the way the guidance reads. Okay, I'm going to skip over that. So when we talk about provisions, one of the things that you'll see when you Nordstrom's is a good example because Nordstrom's is basically a U.S. company. I mean, they've got some stuff outside the U.S., but you pick up their financial statements, you're like, yeah, a U.S. company. When you read Disney's financial statements, I don't know what it looks like, but my guess is it looks more global. And so when you read stuff about their taxes, you'll probably see that it's not just a simple U.S. tax discussion, but it becomes more worldwide-ish. And when we get to NetApp, for example, you'll see it becomes very global. So I want you to think in our class, we'll always start with these like very basic examples, like we're in one country and it's really easy, and here's our simple set of numbers. But on the real world, when we do provisions, we're doing provisions for a group of companies. You know, Amazon must have 500 companies or something, I don't know. And when you look at their 10K, their financial statements, that tax expense, that's everybody. Okay? So later in the class, we'll get into examples where we add jurisdictions and we try to complicate things a bit. But know that as we work on provisions, the same rules apply whether we're doing a U.S. provision for a simple domestic company or a worldwide provision for a big global company. Okay? It's all the same rules. We're chasing income taxes, corporate income taxes, wherever they are. Okay? All right, we're not talking about this stuff. Simple as that. Okay, so when I said earlier it would help if you wrap your head around debits and credits, this is what I mean. I don't know how long it's been since you guys were in accounting classes, but whether it's T accounts or little schedules like this where you show how you do a balanced entry, you're going to want to figure out what works for you soon in terms of how to turn a thought into a journal entry, right? So if I say a company makes $100 and the tax rate's 30%, what's your journal entry? Like, I want you to think of either the schedule or like T accounts or something that works for you in terms of, well, this is what I would do to account for that fact pattern. And then if I said, oh, but they also have tax-exempt interest at $10, so now how would you account for it? And I want you to think, okay, I need a debit and a credit. So how am I going to do that? Okay? And what we're going to learn through the examples tonight is we're going to try to go left to right on this schedule. And as we add facts, we're going to figure out what's our current payable, and then what are our deferred taxes, and then we're going to let the provision fall out. And then the way this schedule works, every row, every time we do something, every time we add a fact, we're going to have a row that's a balanced journal entry. Okay? If it doesn't balance, that's not good. When you guys do your final case study, you'll find that I'm going to have you do a real provision, and some of you will be like, it doesn't balance. And I'm like, all right, well then you need to like back way up and think like this, where every fact you create a balanced journal entry out of it. Okay? When things get sideways, even at the biggest companies, you know, we break it down, we break the issues down into small pieces and we attack it debit, credit, and make it balance. Sometimes when you get a lot of numbers moving around and you just can't see straight between all the different things that are happening in a calculation, it's hard to see what the problem is, but when you break things down, the fact that something is out of balance will become pretty clear to you. We'll do that a lot through the class problems. I'll show you different ways of trying to attack a problem so that you can stay in balance. Okay? To this day, I joke with like young people when we're working on provisions. You know, somebody will be like, "I think it's done," and I'll be like, "Does the balance sheet balance?" And it's a sarcastic comment, right? But when I was a when I was at Deloitte as a senior, gosh, forever ago, I think I had a huge head of hair back then. I remember the first return I ever was the senior on, like the reviewer. Like the staff person gave me the return and the balance sheet didn't balance. And I was like, "Hey man, the balance sheet's got to balance," right? And the person was struggling. It was like one of their first returns, and they gave me the second version of the return back, and the balance sheet didn't balance. And I'm like, "What are you doing?" I'm all, "The balance sheet has to balance. It has the word balance in the word balance sheet." Right? So our balance sheet will balance. Our provision will balance. Okay? Trust me. Okay. Another way to think of the kind of balancing aspect of provisions is the provision that you see in the income statement, in the face of the financials, our total tax expense. It's really made up of three things. Okay? Before I said that I want you to think of the tax you owe now and the tax you will owe or save in the future, and out of that, the balance journal entry will be expense. You can kind of think of it, some people think of it this way. So if you took step one and you said, what's my current tax? Okay. So say I'm a company that makes $100 and the tax rate's 30. My current tax is 30. Right? So I would credit liability. I would debit my current expense. Okay. That current expense, that's the second block here on the slide. Say I'm also that company that has the truck. Okay, and it has that $1,000 basis difference, which means I'm going to pay $300 of future tax. I need to credit deferred liability because I'm going to owe $300 in the future. So I would debit my deferred expense. Okay? And this last box, this non-current expense, that's synonymous with reserves, or the tax you would accrue for things that you thought might be future exposure. So say, for example, you filed your return and you deducted all your penalties, but maybe you needed to add them back and you hope the tax authorities don't catch you. If you still accrued for those under the theory that you might have to pay them in the future if you're caught, you would credit a liability for that exposure. You'd accrue that just like a litigation risk. And you would debit your non-current expense because that expense is probably something you won't realize for quite a while. Okay? So the point of that is every time you debit or credit the balance sheet, in theory there's a current or deferred or non-current expense offset. And the sum of those add up to your total provision. Okay? Sometimes I'll explain provisions this way, where I'll say, well, what's our current expense? What's our deferred expense? Other times I won't really talk like that. I'll just say, look, let's figure out our payable, let's figure out our deferreds, and out of that will be our total provision. And we'll just shortcut it. Okay? We'll do that probably more often than not. But if you wanted to try to think about what makes up our total provision, if you looked at a company's income statement, that number includes the expense for taxes I owe now, the expense for taxes that are due to timing differences like that truck, and the taxes I hope I don't ever have to pay, but I've accrued for because I might have to pay them. Okay? So you take those three things, you add 1 million companies in a ton of countries, and then add it all up, and then you have a big company's provision. Okay, so here's our really simple example of why we care about tax provisions, why we do accrual accounting. Okay. All right, so say you're this company that has a balance sheet with 1,000 of fixed assets on it, and it has a loan of 600 to a bank. So its equity is $400. Right? If you assume that the value of the fixed assets was also 1,000, then you would think I should pay $400 for this company. Right? If the value of the assets is 1,000, they owe a bank 600, then in theory you should pay $400 for this company. So the additional facts at the bottom are the tax rate's 40% and the tax basis in the assets is 0. Okay? So you go out and you buy the company for $400, and because you looked at the balance sheet and you thought, well, I take the value of the assets, I take the bank loan out, and I pay the net, right? I pay net equity. So the next day they sell the assets for the $1,000 and they get cash of $1,000. And the theory is that you can use the proceeds to pay back the bank loan so that you'd have $400 left, right? That's how it should work. But the accountant basically says, hey, you blew it, right? Because when you sold the assets for $1,000, you had $1,000 of taxable income, you gain for tax purposes, even though there was no book gain. So you actually owe $400 in tax from selling the assets. So you have nothing left, right? So you just bought a company and paid $400 for it, but there's nothing there, right? All the money that you got from selling the assets either went to pay back the bank or went to pay the government. And so by paying $400 for that company, the way you blew it is you blew it by not taking into account that there were deferred tax assets or deferred tax liabilities in this case that should have been accounted for at the company. So when you look at a company's financial statements and you see a deferred tax liability in the balance sheet, you shouldn't look at it as this academic thing that is something we calculate but don't really understand. You should look at it as if somebody was going to buy this company, they might want to know that that liability is a real liability, that someday this company might have to pay tax, right? And that should be something that's taken into account. It's not always so obviously economic as it is in this example, but in the most basic sense, like that's why you should care about this stuff. Right? Okay. Effective tax rate and statutory tax rate. This is where it's killing me. My little notepad thing doesn't work. Okay. Statutory tax rate is the tax rate that applies on the incremental dollar of income. Okay, so if you're a big company, you make $100 million, the next dollar of income you make is taxed at 35% in the U.S. Okay? Tax rates differ all around the world. States have their own tax rates. The statutory tax rate is the rate that applies by law on the next dollar of income. Okay? The effective rate. So we will talk about the effective rate. I mean, you should almost count how many times we say the word effective rate in this class, this semester or the quarter. It will be a lot. Effective tax rates, or ETRs, some people call them. You go to, if you have a guest speaker in and you ask what the ETR is, the person will just rattle it off. They just know, right? It's like a shoe size. Your effective tax rate is the tax expense in your financial statements divided by your profit before tax. Okay? So it's your tax expense in the numerator, your provision in the numerator, it's your profit before tax in the denominator. Okay? That ratio will give you an effective tax rate. You want your effective tax rate to be low, right? Lower the better. The lower effective tax rate you have, that means the lower expense you have, that means the higher net income you have, and everyone's happy when the income is higher, right? So one of the most obvious things I want you to look at with every 10K that you open up is, the first thing you should ask is, what's their effective tax rate? Okay? So when you open up Nordstrom's, they have a pretty high effective tax rate. They're a U.S. company. U.S. tax rates are high. When you open up the net app tax rate, or the footnote, or the 10K, their tax rate will be lower. Your question should be, why? Why is their tax rate lower? What do they do? Right? They're based in Sunnyvale. What's going on? That's what we should ask. Okay? So, and every company's different, and in the public company financials, you can find information out about why a company's effective tax rate is what it is. But that is your number one kind of endeavor, is to figure that out. What is the rate? Why is it higher or lower than their competitors? Why is it higher or lower than last year? What could they do to lower it? What could they do to avoid making it higher? That is how I want you to think, right? You know you've done a lot of this when you just think, when people start talking about like a transaction or an issue, you'll just immediately translate it into like, oh, that's what it would do to your effective tax rate. That's when like provision stuff becomes ubiquitous for you. Okay? So I want you thinking journal entries, debits and credits, and effective tax rates. Okay? You should always be thinking, how would I debit credit? How would I compute the effective tax rate? What is the rate? All right? Okay, so throughout this course, we're going to try to follow this sequence of steps where we methodically go through concepts and learn the provision by the end of, I think, class 4. We're through this. I'm not going to say any more about it other than you'll see this slide. We're going to follow this where we kind of go step by step and tackle the components of a provision piece by piece. And hopefully through that sequence there'll be enough structure to have the pieces connect, the dots connect for you. Okay. I think the only thing else I'll say on this slide, we've already covered most of the contents in this slide. But in the second bullet, the middle bullet on the left, you do your provision jurisdiction by jurisdiction. And I can't emphasize that enough, because when you take a company, a bigger company, and you do the provision calculation, it seems overwhelming just because of the volume. But if you think of an Excel schedule with columns, and you think of each column as a jurisdiction, and you think of all the rows as the key provision calculations, that's what a lot of big company provisions look like. Right? Every column is a jurisdiction. And like Amazon has this spreadsheet where it's a kind of a top consolidation, and you can just click the right arrow button to take you across the columns, and you just hold it, and it's just the columns go flying by, and those are all the jurisdictions they're in. And you just keep holding it, and then eventually you get to the end, and then there's an end where they just add them all up. And so if you tackled their provision, you're like, it's too much, it's too big, I can't get my head around it. The way to do it is to just go column by column. When I review their provision, I just pull up a column and I try to understand that column, and I'm not distracted by the other zillion columns that are there. Okay? And so when we do our problems in class, it's all going to be kind of one jurisdiction for a while, but I want you to know that bigger provisions are really just the aggregate of smaller provisions. That's really all there is to it. Okay? All right, we're going to play the Family Feud. This is like the Americana culture that you get out of this class as well. Okay, so hold on, let me pause our... Okay, so, all right, so in the feud game, the first question was, what kind of items impact a company's effective tax rate? And the answer broadly was permanent items. Okay? Permanent differences. So differences between book income and tax income that are permanent in nature. Okay? Things that are permanent will impact your effective tax rate. And the reason is they permanently increase or decrease your provision. So the numerator of your effective tax rate calculation goes up and down, okay? And the denominator stays the same. So permanent items. So these are differences that exist by law, where if you would line up kind of the rules for book accounting in one column and you put the rules for tax accounting in, or doing taxable income, calculating taxable income in another column, there would be differences, and those differences are permanent. Okay? So some examples: non-taxable income like tax-exempt interest, right? So if you buy a bond and it's tax-exempt, the interest on that bond is never taxable. Okay? It shows up in book income because it's income. It doesn't show up as taxable income because it's tax-exempt. It never shows up as taxable income. So that difference is a permanent difference. Okay? So you can imagine if you had $100 of income and it was all tax-exempt, your effective tax rate is going to be 0 provision in the numerator because you're not going to pay any tax, right? All your income is tax-exempt. Your denominator is 100, so your effective rate's 0. So the fact that you had tax-exempt interest, something that was permanently tax-exempt, would reduce your effective tax rate, right? I know that's really basic. Fines and penalties, okay? So if you're a company that has $100 of income and you'd expect to pay $35 of tax, if within that $100 of income is a bunch of fines and penalties, say there's $10 of fines and penalties that cause you to have 100 of income instead of 110, okay? That fine and penalty, that wouldn't be deductible for tax purposes. So your tax is not going to be 35. Your tax will be 38.5 because it would be $110 of taxable income times 35%. Now the numerator of your effective tax rate calc is 38.5. Your PBT is still 100. Your effective tax rate is higher. The fact that that fine and penalty is not deductible, it's never deductible. It's not that it's deductible next year or the year after that. It's never deductible. Okay, so it's permanently different than books because books recognizes as an expense. Okay. Meals and entertainment. That was one of the survey answers. Tax credit. So a ton of companies in Silicon Valley take an R&D tax credit. So the government gives you a credit for doing research. And if you do the right kind of research and the math all works out, you get to claim a credit. That credit reduces your tax liability, and it does so permanently. Okay? So when we read companies' financial statements, I don't know that Nordstrom's has an R&D credit. I would kind of think not, based on what they do. But as you look at other companies' financial statements, look in their disclosures where they explain how their effective tax rate's calculated, and you'll see R&D credits very commonly. Okay? NetApp will surely have one. I don't know about Disney. Okay. So when you read the guidance itself, it doesn't refer to things. It doesn't refer to the terminology as permanent difference, which is a little confusing. But it's very important for you when you think back to that first slide where we were talking about book income and how you get to taxable income. It's very important for you to be able to identify all the differences between book income and taxable income, and segment those or separate those into permanent items and timing items or temporary items. Okay? Permanent is nothing more than what the word says, right? It's a permanent difference between book and tax. So in your mind, as you think about what differences you see on a tax return, you have to think about it whether it's a permanent difference or a temporary one. Okay? So temporary differences, on the other hand, are where there is a difference between the book and tax treatment of an item, but ultimately that difference will reverse in a different period. Okay? So depreciation is a great example, right? If you buy a truck for $100, books will expense $100 as depreciation over time, tax will deduct $100 over time. They will almost never do it over the same period of time, right? Books might say the truck has a 3-year life. Tax is going to say it has a 5-year life. Okay? So when books expenses the truck is going to be different than when tax deducts it. But over time, they will be the same. Okay? At any point in time, there might be a basis difference in the asset or liability, but that basis difference is a function of a temporary event. Okay? So that can exist for lots of things. I mean, depreciation is an easy example, but a bad debt reserve, somebody mentioned when we were doing the feud, that's a good example. So when the books writes an asset, an accounts receivable asset, down from 100 to say 90 because they don't think somebody's going to pay 10, books takes an expense of 10, but the tax rules say you can't deduct the 10 until you basically walk away from the receivable and stop trying to collect it, largely because the person goes bankrupt. Okay, so for books, there's an expense of 10 before there's a deduction for tax of 10. And if at any point in time you looked at the asset, the receivable, you would find that it has a book basis of 90, because it has the written down value, and the tax basis in the receivable is 100, because you picked up 100 of revenue to establish that receivable. Okay? So you have an asset that has a basis difference. Right? You could have a truck with a basis difference. You could have an accounts receivable with a basis difference. You could have inventory that has a book and tax basis difference. These are all things that are temporary in nature because it just is a function of when books will recognize something and when tax will. But over time, they'll come back together. Yeah?
In the earlier example about some guy trying to buy this company with an equity of $400 because and you said because there's an unreported deferred tax liability of $400, so he basically paid $400 but got nothing. But is that going to reverse later, or is that already like a?
So that's a good question. So in the example, we said there was an asset, it was a fixed asset property called a truck for $1,000. And it had tax basis of 0, right? And I don't know if you caught it, but when we were going through the example, it said at the bottom, the reason that it had 0 basis is because it was depreciated quickly for tax purposes. So that company already claimed a fast tax deduction for the property, and the book expense hadn't yet happened yet. Okay? And all that's happening in that example is when that person sells that fixed asset, that difference reverses, and they pick up taxable income when the asset's ultimately sold. So in the example, all you saw was the reversal part. You didn't really see the front end where that temporary difference got created. But in theory, if you could rewind the clock on that example, you would have seen in year 1 excess tax depreciation. Okay. Your question is really good because in later classes, we're going to learn that there are temporary differences that don't necessarily have a reversal pattern, but that's for like way later in the quarter. Okay? For now, assume that there's always a front end and a back end.
So in that case, he lost that $400 because they never recorded that on the books.
Yeah, in that example, it was a surprise because no one said, look, when I took that excess depreciation, I accounted for the fact it would unwind on me. Right? That was the issue. Okay. How to identify differences? This is one of those where if you're working and you have experience and you're doing tax returns, you kind of already know where to find permanent and temporary differences, right? You go to your Schedule M3, they even make you call them permanent and temporary differences now, so it's pretty straightforward in terms of if you know your way around a tax return, how to find permanent and temporary items. If you don't have experience doing tax returns, then you need to kind of think back on, is this a difference in law that is permanent or temporary, and think from that perspective. Okay, so let's do, it's enough talking. Let's get to kind of trying to apply our basic 3-step process. Our 3-step process being, the first thing we do is calculate our liability. The second thing we do is we calculate our deferred taxes. And then the third is we let our provision fall out. Okay, so we're going to try to do that through some simple examples. All right. So let's say that we have book income of $500,000 and we have no temporary differences or permanent differences, and our statutory tax rate is 40%. Okay, so if we're going to apply our 3-step process to that fact pattern, and we're going to come up with a balanced journal entry. So our first step, so Sam, what is the first thing that we're going to do?
Identify.
Our first step is we're going to calculate our current liability. right? So how much tax do we owe, Sam? 200,000. Okay, so if we're going to set up a journal entry, are we going to debit or credit our tax payable? Okay, hang tight, you're good. So you're going to credit your payable in step 1, right? You owe 200 grand. You're going to book a liability, so you're going to credit your payable for 200 grand, right? Okay, Joyce, what was our step 2? No, our step 2 is we're going to figure out our deferred taxes, right? I know there are no deferred taxes, but we still have our step 2. Every time we're going to have the same 3 steps. So our first step is, what's our current liability? Sam told us it was 200 grand. Our second step is figuring out what our deferred taxes are, and Joyce told us they're nothing. Okay? So our third step, Hop, is what? What's our third step? The provision just falls out. Okay? So Sam said in step 1 we have to credit the liability. We have to book a credit entry to our tax payable for 200 grand. Joyce told us in step 2 we don't have to do anything because there's no deferred taxes, so there's no entry to book. So now if we want to balance that journal entry and all we have so far is a credit to taxes payable of 200 grand, we're going to debit the provision for 200 grand, and our provision will fall out in our balanced entry. It'll be 200 grand. Right?
So we debit provision expense?
Right, so our journal entry, this is killing me that my tablet doesn't work, so I can't write on the slides at the moment. I'll have to figure out how to fix this. But our journal entry on the solution would be, we'd credit the liability for 200 grand. That's in the third column here. We wouldn't do anything in the middle section because we don't have any deferred taxes. We don't have any temporary differences. And we would debit our tax expense, and here it's shown as a current tax expense because we're saying that this is something that we owe currently, and our entry balances. Okay? Alright, so this isn't in the example here, but so Scarlett, so tell us what is our effective tax rate in example 1, Scarlett? And you're going to have to talk really loud because you're in the corner and these fans are blowing and they're way over there. Okay, so I'll give you the benefit of the doubt. I could hear you, but they couldn't. So Scarlett said that the effective tax rate was the same as the statutory rate, and it just so happens to be the case in this example because we don't have permanent or temporary differences to muck things up. Right? So our effective tax rate would be our provision in the numerator, which Hop said is 200 grand, and our denominator is the 500,000 in the example of PBT, so our effective tax rate is 40%. Right? Okay, so write on your paper, 200 over 500 is 40%. If I could write on my slides, I would write that for you. We're going to do the same thing in the next example, and the next example, and the next example, and I want you to see how the effective tax rate changes. Okay? Okay. All right. So example number 2, we're going to use the same base case, 500,000 of income. No temporary differences. But there are meals and entertainment expenses within that 500 grand of $30,000. And the tax rate is 40%. Okay? We got that? Okay, so Violet, what is our first step? Book the current tax payable. Okay, so what is our current tax payable? Oh, don't worry about the debit expense. Worry about the payable. How much do we owe as a liability? 200K. Okay. Anyone else want to help Violet get to a different answer that might be more appropriate, as Nita says? Hold on. Tejal. 206. Okay, so explain to the class how you got to 206, because not everyone got that.
50% of meals and entertainment
Right. Right. Okay. So only half of the $30,000 expense for meals is deductible. The other half is non-deductible. So our taxable income isn't 500 grand, it's 515 grand. So our tax liability is 40% of 515, right? Or 206. So step one, our liability that we would accrue a payable for would be 206. Right? Okay. All right. So step two. Jose,
Yeah.
what's step two?
Step 2 is the deferred and the automation.
Okay, Jose says there are none. Okay, good answer. Okay, so now, what happens in step 3? You're the only now here. Debit the expense for 206, right? We're going to balance our entry. So we credited 206 because Tejal said our tax liability was 206. Jose said we had no deferreds. So to balance that entry, we're going to book expense for 206, right? Okay. So the way this is shown in the solution, I've flipped to it on the slides here. You can do it the way I just described it verbally, by aggregating the total tax liability and the total expense. Or if it was easier for you, you could put a journal entry to every fact that we went through. Right? Like you could say the journal entry for having 500,000 of income is the first line here. The journal entry for having a permanent difference of 15,000 would be the second line. And I'll add up all my journal entries and I'll get to the same answer that way. Okay? As you can imagine, if you were doing a big company's provision, doing it the way it's shown on the slide here is not going to be the most efficient way to do it. But if it helps you learn it, great, do it this way. Okay? And if this gets you into like a debit and credit mode where you just put a debit and credit to everything that comes up, that's the way that it's presented for this way for that reason. Okay, so Connie, what is our effective tax rate? $206 over 500, right? So that's like 41%. Don't worry about the exact number. Okay, let's call 41% for the moment. Okay? All right. So, what did we learn about the effective tax rate in example 2? So Cindy, so when Connie says the effective tax rate is 41%, and then you think, well, the effective tax rate was only 40% in example 1, like what is the takeaway from that? What do you learn from that? The permanent difference increases our tax expense, right? And that increases our numerator, which impacts our effective tax rate, right? Okay. All right, we good with example 2? Okay, taxes went up, they went permanently up, our provision went up. When our provision goes up, our effective tax rate goes up. Okay?
Sure.
All right, so it's getting more complicated now. Example 3. So we have the same book income of 500 grand, the same meals and entertainment issue of 30 grand, for which we said 15 was non-deductible. But we also have, embedded in that $500,000, we accrued in a vacation expense of $200,000. And that vacation accrual is sitting on the balance sheet as a liability at the end of the year, let's say. Okay? Okay, so Vicky, what would you do in step 1? Well, you gotta talk way louder, Vicky. You calculate the current expense. Okay, so what is our taxable income in example 3? Behind, what do you think? Can I call you behind, or do I have to call? So we had 500,000 of book income. The vacation accrual is implicitly non-deductible currently. It's deductible when you pay it. Okay? Oh, you're jumping ahead. So if we're getting to taxable income, we start with the 500, we add back the 200. That'll be deductible in the future, right? It'll be deductible when we pay it. And then we add back half of the 30, right? Or the 15. So our taxable income is 715. Right? So we should get 286 of tax liability if I did the math in my head right. Right? All right. So step 1, we owe 286,000 of tax. So we would credit our liability for 286. All right. Ellie, so what would we do in step 2? Identify the deferreds, okay? I realize we're just learning this, but what do you think our deferreds are here? Vacation accrual, okay? So why is that a temporary difference? Describe in your words why that's a temporary difference.
Because we're going to pay in the future, now we depend on the expense.
Yeah, it's not so much you're going to pay in the future, you're going to deduct it in the future, right? So books is expensed it now, but we're not going to be able to expense it yet. We have to deduct it later, right? And when we deduct it later, we're going to save tax compared to what not deducting it later would give us, all right? So we needed to put up a deferred tax asset now because we're basically saying, hey, in the future, we have this good thing coming, and that good thing is in the future, is in the form of future tax savings, okay? Okay, so our deferred tax asset is a future deduction of 200,000. So if I was trying to book an entry for that in step 2, Nellie. Oh no, I'm off of Ellie. I'm on to Nellie. Sorry, I didn't realize I was getting so close to your names. Sorry. No, I'll let you off the hook. Okay, so Ellie said that there's a future deduction of 200, and that's a temporary item. And that's going to give rise to a good guy in the future. So now we're trying to turn that into what do we account for? How do we account for that? Right. So what entry do you think we book, Nellie? Okay, so Nellie did it perfect. So Nellie, except you ended with a question instead of just saying that's the answer. All right, so Nellie said that you should book an $80,000 asset, or you should book a debit for $80,000. Okay, and so why did we book it? Why did we book 80,000 and not 200,000? We're booking the tax effect, right? The reader doesn't care what your future deduction is. The reader cares what is going to change from a cash perspective ultimately in terms of taxes, right? So just like our payable increased by an extra 80 compared to example 2, our deferred asset is 80 because in the future we're going to save 80, right? We pay 80 more now and that's in the payable. We're going to save 80 in the future and that's in our deferred tax assets. Yeah?
And you got the 80 from the 200,000 times the
The 200,000 times the statutory rate.
Okay.
Okay? All that represents is, in the future, our temporary difference will reverse. We'll get a deduction. That deduction will result in a savings of tax. That savings of tax will be 80 grand. That 80 grand is our asset, because in the future, we're going to basically convert that to cash of 80 grand. Okay, so Ziad, so what is our effective tax rate?
That's 206 over the 500.
Well, actually, I skipped a step. I didn't do our step 3, huh? See, I told you I'd boot stuff too here. Okay, so Ziad, you can do step 3 instead. Don't worry about the effective tax rate. So what is our provision? You said it, but that made me realize we'd actually hadn't discussed it.
So the current 286K and the deferred of 80K benefit, that's 660
Right. Right. So we're saying our total payable is 286. That's on the bottom of the schedule here. That's a credit. Our deferred tax entry is an $80,000 debit. Bless you. So what falls out is a 206 net debit, right? Okay, so 206 is our expense.
And then
Okay, so
the
somebody ought to like immediately think 206. Man, I've seen that number before. Where have you seen that number before? Second example, right? Okay. So Veronica, so if that was the answer in the second example, how can that be? Like, what did we just learn from that epiphany we just had? That we got the same provision expense in example 2 and 3, even though our provision expense was different in example 1. What is the aha moment we're hoping to have right now? Coincidence? Oh, come on.
Look at the permanent difference in tax year effective rate.
Stu, try to explain it? The temporary differences don't change your provision, right? All the temporary differences did, and when you're looking at this page in front of us, it caused your payable, your first set of columns, to be higher, but it was merely offset with an entry to deferred taxes. So the two of those things wash, and nothing actually changes in the provision column. So a temporary item will change when you pay the tax, and therefore which column is affected in terms of payable versus deferred. But it doesn't change the total amount of tax you'll ever pay, which is what the provision is trying to represent. Right? Because on that $500,000 of book earnings that we had in this example, the tax that we'll ever pay over the life of this company will be 206. We'll pay 286 now, and we'll get 80 back later, right? But over the life of this company, we're paying 206. And in example 2, we were going to pay 206, right? We just paid it at a different time. Okay? So temporary differences aren't changing the total amount of tax that we pay. They just change the timing. And if the provision is there to represent the total amount of tax we'll ever pay, that is why in example 2 and 3 we get the same answer. Okay? This is when you should do like the collective, I got it. Right. Okay, let's just keep going a little bit. Okay, so what is our effective tax rate?
41.
Yeah, the 41%, because it's still 206.
Megan, what is our effective tax rate? 41%. Same as example 2, right? I know, that's not a hard one. Okay, we getting that? If you get nothing out of tonight, get that. None of the answers in the feud game to what impacts your effective tax rate were temporary differences. They were all permanent differences, right? Meals and entertainment, R&D credit, state taxes, all those things permanently change the amount of tax you have to pay. None of the items in our second tax board, which were all temporary items that changed the second column in the answer sheet, none of those impact your effective tax rate. So when you guys were answering like depreciation for what impacts your effective tax rate, that wouldn't have been a correct answer because all that was doing is changing these first two columns. It wasn't driving the third column. Okay? All right. Example 4. All right, so let's say we have book income of 500 grand, a vacation expense accrual of 200, it's the same thing. Meals and entertainment of 30 grand, same thing. But now we've said there's a tax contingency reserve of 60,000. Okay? And let's say that's for state taxes. Okay? Let's say we didn't feel like paying state taxes and we didn't file any state tax return. But if the states figure that out, they're going to come and make us pay 60 grand. Okay? And I know that's kind of a silly example, but let's assume that that's our fact pattern. Okay? All right. So we got to do step 1. So Mina, step 1. What would you do in step 1 in this situation?
Determine what is the current payable.
Determine what the current payable is. Okay. What's that?
So for the book income will be $500,000 multiplied by statutory treasury of 40%, which is 200,000 each. And then vacation expense, which is currently not deductible for tax. So take the $200,000 multiplied by 40%, which is 80,000. And meals and entertainment, so I take $30,000. Take half of that, which is 15,000, and multiply by 40%, and that's 6,000. And
Okay, so now you're up to 286, right?
286.
Okay, same as example 3.
Yeah.
Okay.
So and then state tax, just a tax, and just added into.
So that's 60,000 of tax. That's effectively like another current payable, right? We owe it. We're just not paying it voluntarily, right? We're going to make somebody come and get us. We're going to make Eugene come and get us. He's going to go back to work at the FTB when he finds this out, right? But if we want to accrue that liability, it's just like accruing any other liability that we would voluntarily pay, all right? So we still need to accrue that payable on the balance sheet. Okay, so the total payable we're going to book on the balance sheet in this example then would be the 346, right? Okay. Okay, so Brittany, so what would you do in step 2? Okay, and how much is the deferred tax? In the future, we're going to get a deduction for the 200, right? For the 60, okay, so maybe this is confusing. When you pay state taxes, you get a federal deduction. I don't want to complicate the example with that, so let's assume that's not the case, okay? Let's assume that there's no such thing as federal deduction for state taxes. It just gets complicated. So our deferreds, if the 60 was just an incremental tax all by itself and didn't give rise to any other effects, your deferreds would still be the same 80 that they were in the prior example. Right? I shouldn't have picked state taxes. I should pick like fines and penalties or something. It'd be a little easier. Okay, so Ming says, or no, sorry, Mina. Mina says we should book a liability of both the 286 and the 60. And then we're saying that our deferred should still be the same debit of 80 that they were in example 2, because we're going to get the $200 future deduction, right? So our expense that falls out from that is going to be what? 266, right? Okay, so bingo. So again, this slide shows the same thing with each little fact broken out into its own journal entry, or you can skip straight to the bottom and see what we just said. Okay. So if we did our effective tax rate, so Devin with the deep voice, if we were doing our effective tax rate, what is it in this example? 266 over 500, right? So whatever that comes out to be, it's more than 50%, right? It's high. So our effective tax rate went way up, right? Because we had to pay state taxes. And we said that those state taxes are just a permanent increase in the amount of tax we need to pay. So just like any other permanent item, it's an increase to tax expense. Therefore, it's an increase to the effective tax rate. Okay. So let me just pause for questions there before we go on to talking about Nordstrom's.